You need to know what the market is going to do or whether the market has changed. So, my strategies, I resolved to go with the approach that trade the strategy all the time. And you're going to have some periods that can be long where you're losing money.
Welcome back everyone. Today I'm sitting down with Michael Grech and we'll talk about his journey as a quantitative trader, going from manual to quantitative with algos, over 10 years of experience in the market. So pretty cool story here to hear. Michael, how's it going? Welcome on the podcast today.
Thank you for having me. I haven't done a podcast in a couple of years, so it's exciting to do one again.
That's awesome, and thank you for doing this during the holidays. Also, I know we're busy with celebrating and Christmas and the New Year and stuff upcoming pretty soon. So I appreciate your time for this. And I know we have a lot to talk about here, but I kind of want to begin with, tell us a bit more about what you do these days, kind of what kind of stuff you do in trading, and kind of a bit of background about yourself.
Well, these days I don't do much trading. I was a full-time trader for about 10 years, and nowadays it's only part-time, and I don't do any development anymore. When you're a quantitative trader, most of your time is spent developing, or you don't spend much time trading because it's either fully automated or semi-automated. And so all my strategies are the same now, either fully automated or semi-automated. So if I don't do any development, I don't need to do much. Maybe a little bit of caretaking every now and again, but that's pretty much it.
Pretty cool. So you took time to kind of build it up, put it to a point where you're able to go fully automated, or most of it fully automated.
Right.
And now you can just kind of not spend too much time on it, but just let it run, and the algo takes trades. You're happy with the performance, right?
Right. That's right. Yeah.
Interesting. So let's go back in time. Tell me a bit more about how you started trading. Like, what was the first time that you went to the market and actually started trading?
Well, I started back in 2008. That was, after the big financial crisis there, 2008, 2009. Essentially, what got me into the markets is I had a business at the time. So I had my own business. And, when I started out of college, like 10 years prior to that, I mean, I had met with a financial advisor and some of the elder people at work, they had told me you need to start investing 10% of your monies. And anyways, and so I had put my monies in the markets. And then 10 years later, essentially they had gone nowhere because I was quite unlucky. I mean, I started out when there was the tech bubble crunch back in 2000. And then in 2008, there was the financial crisis. So, I hit, what was it called? The lost decade, I think they called it in the financial markets. So I realized, well, I mean, here it's gone, 10 years have gone by and I haven't made any money. So I decided to try and learn a little bit more and maybe take a more active involvement into it. So I started doing that. And then lo and behold, one thing led to another, and I started becoming a full-time trader. So I didn't start away as a full-time, like a quantitative trader. In the beginning, I was buying stocks. Essentially, I read Warren Buffett's book about value investing, and of course, everybody knows about Warren Buffett. So I started looking for value stocks, which in 2008, 2009 was essentially a slam dunk, everything was down. So wherever you looked, you just had to pick a dart and throw it at the wall and pick any stock and find the most beaten stocks and buy them. So yeah, and then 2009 came around, and so everything went up in 2009, right? After March, everything went up. So pretty much everything I bought went up by 100% or more, right? So I thought I was into something, so I tried to do it all over again, but then 2010 hit, and so it wasn't as good. Essentially, I mean, there was some good stock selection, but there was also the market movement that was making all the difference. So at that point I realized I don't want to kind of be guessing. I don't like it was stressful to be guessing. I felt like I was trying to make a guess of which stock is good, which stock is not good. But so I decided that's when I said, well, I need to try and find a more systematic way of deciding what's a good buy, what's not a good buy. And that's kind of when I decided to tap into my physics background and math background and went into quantitative trading. So I developed a strategy. It was a day trading strategy that essentially would look for value buys and then hold them about a day and then sell them the next day. So from then on, and then I could backtest it over 10 years or more of data. It used intraday data, so I can't remember how many years I have. I had a lot of years. And so I said, I'm not making any guesswork anymore. I'm just going to take the guesswork out of my investing decisions.
So when you said you took your quantitative background, what kind of parameters did you think about in terms of becoming profitable with your trading? Did you kind of have an idea of like what to code already, or did you have to sort of figure it out right there, or what did you kind of put in place to start to code, start to get some data about your trading?
I mean, the first step was to get data, which was, I think I used IQ Feed at the time to get intraday data, which was fairly inexpensive, like in the hundreds of dollars per year, and you get live data subscription and everything. And I know I developed the strategy based on observing the markets. Like I said, I was essentially looking for stocks that were down, and then try and buy them on the rebound, which is kind of, I mean, later on I learned this called mean reversion, right? I didn't even know at the time it was called mean reversion, which is one of the most basic strategies. I mean, a lot of people who I see trade whatever you're trading, they're either trading momentum or mean reversion, pretty much, right? Some version of it. So that's what I had, and yeah, so I had a background in coding in Fortran, so I didn't even learn any platforms. I wrote all my code and I had all my data, and so I did all the testing on my own and went from there. Yeah.
Was the strategy possible from the start? Did you kind of get a good job with it from the start, or did you have to kind of tweak it a lot to get there?
No, it was not proper. On paper it was. In the backtesting it said it was, but then it turns out 2010 and 2011, after the big rally, 2009, there was the crisis, the European crisis with Greece and Italy and all defaulting on debts and stuff. So the markets, they tanked in May, and the strategy didn't do well. I mean, it did well some years. My stuff was more of a I would say more of an investment approach rather than a trading approach, and in the sense that I wasn't trying to make money every day. Of course, it's nice to make money every day, but I was more of a like, as long as I make money over a 3-year period, 2-year period, 3-year period, that's kind of my, so even in the backtesting, we show maybe the strategy would lose money over a 1-year period, right? So, however, I noticed the discrepancy between my backtesting and my actual live trading. And then that's why I realized that I had it properly accounted. I mean, this was my first experience at it. I had it properly accounted for the effect of slippage. And so I was buying, I don't know, maybe 10 stocks, sometimes even more a day. And I was buying them in the morning when things are moving really fast. And so the effect of slippage was substantial. And so when you're buying stuff that frequently, and when you're buying stocks that are moving fast, the effects of slippage adapt. And so that, combined with the fact that the market had changed, market conditions had changed, it was tough to make money. And so I lost money in the first 2 years. I lost money. Then things turned around, and 2013 was a nice, good bull market. And so that helped me recover my losses and do very well. However, I learned a very important lesson is that to properly account for slippage, of course, and commissions, which I had already accounted for commissions, but slippage and commissions. And 2 is I started at that point looking for strategies that had a more longer time frame. So I didn't want to hold for a shorter period of time. So I wanted to decrease essentially the number of trades, right? Because that's the only way you can minimize the slippage is if you're not trading as much. So yeah, so those are some adjustments I made. And from then on, I kind of let go of this strategy and moved on to other stuff that was more like swing and longer term strategies.
Interesting. I want to go back on something you said, which is you lost money for 2 years. And I know a lot of people doing this would kind of give up after a year or so of losing money. What made you want to stay in the game? Was it the data you had, the backtest you had before that gave you an idea of like you could have a good run after, or was it something else that kind of kept you in the game of trading when you were losing for 2 years?
I think it was, I saw it as a problem that needed to be fixed. I wanted to kind of if I do this and this, like I knew what the problem was, and I had belief in the strategy, and I thought if I fix the problems with the strategy, then it would help. So that's kind of how it was.
Interesting. So instead of being discouraged by the losses, you actually want to figure it out, want to find a way to make it work, and solve the issue with the strategy.
Yeah, I guess I'm a fighter, but don't take me wrong, it was nerve-wracking. I mean, my only saving grace at that time is because I didn't have a lot of money in it because I was just starting out. And I also had the luxury, I mean, I have to say that I also had the luxury that I had just sold my business. So I had some time to play around with life and decide what I want to do. I mean, I wouldn't have that luxury today, but I had it at that time. So it was also dependent upon the circumstances in my life too.
So how did this evolve from there? Because I had a look on your website before, just before we went on for this interview, and you have a bunch of strategies on your website listed. You have a lot of different things. You have some ones for bigger capital or capital and stuff. How did you kind of work this out over time? Did you have to develop them like all at once, or did you add them over time? And what role did they all play together, these strategies?
Well, yeah, I mean, so after that, like I said, the strategy recovered in 2013, but I had learned my lesson there. I wanted to move to something that didn't trade as many often, didn't have as many, wasn't so expensive to trade, and also to trade by, I mean, the daily cost, the fixed cost, and also the carrying cost. Because like when you have a drawdown of 1 year, I mean, psychologically it's very hard, especially when you're doing it full time. If you're doing it part time and there's a small amount of money, then it's like any investment. And so after that, I started looking for alternative strategies, like I said, that were more longer term and not expensive to trade. So for example, if you're in a drawdown, your running costs are lower or essentially zero if you're holding, right? So I developed quite a few more strategies after that, and I varied also my approach, my markets. I went from the stock market to ETFs, and then I had people ask me like about trading strategies. So I decided to make some strategies public so that people can follow me, right? And I looked into starting a hedge fund, but in Canada it's quite expensive to do. Unlike in the States, you hire a lawyer and $15,000 later, you're ready to roll, right? But in Canada, I'm not sure if you're familiar with this, it's much more difficult and much more expensive. So I came across Striker at the time, which is this futures brokers in the States, and they have systematic trading, which is what I do, and they allow people to subscribe to other people's strategies like me, and they take care of all the legal work, of all the management or everything. So then I decided to post some strategies over there, and I have clients to this day that still follow me. So it went from one thing to the other, I suppose, like a natural progression.
How much work is required in strategies now? They're all coded, I guess. They're all kind of written out and optimized for what you want them to do. But how much ongoing work do you have to put on them to kind of maintain the strategy working over time?
Right now, I mean, I just check them once a year, really, and I hardly make any changes to them. Maybe I make some minor tweaks. I mean, this year I had to make some tweaks because the market changed. We went, I mean, from the 10-year bull market to a much more volatile market now over the past year and a half, and with inflation rates rising, finally. So, but I don't tweak them very much. It's probably about once a year that I look at them and make some adjustments.
Is there any difference to kind of type of market we're in? Do you adapt for these kind of market changes, or does that not impact your strategy too much?
Oh yeah, definitely. Like there was a big difference. Now I think the market has settled again. As of March, especially volatility. I was very big into volatility. I mean, I made a lot of money and lost money too in volatility. And that was really went through some turmoil about a year ago when again as it transitioned, as the market dropped, volatility spiked, which was different than before because interest rates have changed, right? So I think it was what they call a regime change. But now, as of the past 6 months, volatility has settled again, and even though the markets have gone down and they're still going down, volatility is still making money over the past 6 months. So it's kind of gone back to normal. But the key, as always, with these strategies is to be able to withstand that the transition period that can be a long time. A year and a half of losing money can be rough, you know.
Yeah, definitely. Now, I know some people who have maybe a coding background, they want to get to coding their own algo, their own strategies that will be fully automated in the future, perhaps. And they don't know like exactly what to code. Like, should they kind of follow a manual strategy and then code it to being more automated, or should they kind of create something from scratch that's fully automated from the start that you cannot really replicate live? You think there's a different way to do it? Is it better to kind of take something manual that you code, or you kind of go with something from scratch that will be fully automated?
Well, I think this is just my opinion. From my experience, I have a couple of friends that trade Forex. One of them follows price charts. The other one follows a confluence of technical indicators. And I think the difference between what I do and my strategies and theirs is that I think mine are much more simple. You know, I think when you are doing manual trading, essentially you have, first of all, different strategies in your head, possibly, and you're looking at different things. And so you can be more sophisticated in a way. The drawback is that you have to be there, and it's very limited in the sense in terms of backtesting or anything, right? So I think manual, and this again is my opinion, manual trading is more of a combination of art and science, whereas quantitative is purely science because you're following the rules. I mean, computers only follow rules. There's no, artistic or emotion. The advantage of coding stuff is that you take the emotion out of it. And that's kind of what I like. I mean, so the psychology is easier because you set the strategy. You can backtest it, right? I mean, that's the first step. And you can backtest it over 5-10 years of data. The longer, the better, in my opinion, as much data as you can get your hands on. And then you set it and you can forget it literally and see how it does manual. So you don't have the day-to-day challenge of the psychology. But I think you're limited in what you can do in terms of coding, right? Versus what a human being can process.
And at the same time, some people might have their algos that they code, but then they test it really well. They have really good stats on it, but they come in the market and then the algo doesn't perform as they expected. Like they might have like a really good equity curve in the backtest, but a bad equity curve when they trade live with it. Do you know what can cause that and how do you recover from it? I'm sure you've seen that before.
Oh yeah, I've seen that before. I mean, that could be various reasons. I mean, the most obvious reason, the first thing you would have to check is like hindsight by an overfitting, right? Like, so essentially, given enough indicators and given enough moving parts, you can make any market look profitable in the past. And so, however, the more complicated the system is, the less likely it's going to work in the future. So, and you can test this idea out, even and I mean, you always, when you're doing backtesting, you're always curve fitting. I mean, that's the nature of backtesting. You're always curve fitting, right? So if you start with the simplest strategy of all, just take a moving average and you buy when you're above the moving average and you sell when you're below the moving average, right? So that is one variable, one indicator like that, right? So you can run that a backtest and see what it does. Now, that is not very likely to change in the future because it's just one. As soon even as you go to, let's say, 2 moving averages, right, then that's significantly more variable, and so less likely to work in the future. So that's would be one sign that if things don't work right away as you start with live data, then you probably have overfitted the past, and so your results are essentially meaningless.
Interesting. So you said the more variables, the more risk for over-optimizing your strategy, which is a good point. Yeah.
Right.
Do you find there's a good balance of like how many variables you look at? Is it like, do you prefer to keep it very simple, or do you like to go with like multiple variables? Is there like some kind of a sweet spot in terms of the variable you use, or?
The simpler the better, right? So I can tell you this much. Like the more variables you're gonna add, the nicer your results are gonna look, but the more likely they're to be false, right? So essentially, I think one thing I like to add here too, and this applies to both quantitative trading and also manual trading, is that Indicators, whatever indicators they are, they're just essentially an oversimplification of the price chart, right? Take the moving average. It's a simplification of the prices, right? You're averaging the price over 5 days, 3 days, whatever, and you're simplifying it. It's smoother. You're losing information. Every time you're using an indicator, you're essentially losing information. So what is that doing is, however, it's allowing you a systematic way to process the information or to process the information in the chart. For example, using again the same simple example of the moving average, if you buy below it and sell, you buy above it, sell below it, you have a systematic way of approaching it, right? Whereas just looking at the chart, there's no systematic way of trading it necessarily. So I think it's important to remember that there is no new information in indicators. Whatever is in the chart is what is in the chart. The indicators are not magic. They're not going to provide you with some secret or anything. There's nothing new in them, right? Yeah. So, and the other thing that I would add too is that indicators tend to be redundant. So if you use 3 or 4, you probably can get by away with 1. There's no new information in adding 2 or 3, right? And so again, you're increasing your risk of overfitting for nothing, right? And so just see in your mind, you need to understand what you're trying to capture. You're trying to capture momentum, for example. Then pick one momentum, and that's enough. Right, and so the least amount of indicators to use is the better, in my opinion.
Then it comes down to what I've seen a lot with algos. Sometimes when you're trading manually, you can kind of pick the right market to trade, the right times. But when you have an algo, then it's going to trade all the time with that specific set of that indicator in the market. How do you filter this out to only trade when the market is conducive for these kinds of trades?
See, that's the thing, right? I mean, to try and filter it out is a strategy in itself. Right. And so what you can do, I mean, the simplest way to do it would be to have an equity filter. Say, for example, if the strategy has 3 losses in a row, then stop it because the market conditions are ideal. But who's going to say whether the market is going to turn after that? But, it's going to protect your bottom line, essentially, if things go horribly wrong or if the market has really changed. But it's, again, I've thought about this in the past, but you can't really, because like knowing what the market is, you still implies you need to know what the market is going to do or whether the market has changed. So my strategies, I resolve to go with the approach that trade the strategy all the time, and you're going to have some periods that can be long where you're losing money, right?
And this is why I guess it's important to have a portfolio with it, where you combine multiple strategies within one account to kind of see how they all play together.
Right. I mean, that's I think a better approach where you have different strategies and doing different things. Like for example, a simple strategy like a shorting strategy. If you have a simple portfolio of stocks and you have a long strategy and a short strategy, I mean, in the short strategy, you would probably have lost money for 10 years in a row, right? But now all short strategies over the past year and a half are like making a lot of money. Why? Because the market is going down. But you need to incur that as a cost. Nothing is free, I guess, in life, right? So you can't have anything for nothing. So
do you have any preference when it comes to either intraday quantitative trading or based on like a bigger time frame? Is it more like an investing perspective you have, or is it more intraday trading you tend to follow, or is it like a mix of both?
Just because the nature of my programming, I did some intraday trading, and I used to, like when I was full time, I had some intraday and I had some longer term. Nowadays, it's mostly longer term because I wanted to be more hands off. And so, yeah, and again, it's easier, I think, to find advantages in longer term than shorter term because your costs are lower, right? So your barriers are lower in longer term than in shorter term.
Now, there's always going to be a temptation for a algo trader to want to turn off the algos, want to take them off because they're not performing really well in the charts that they trade. How do you kind of deal with that? Do you tend to turn off your algos sometimes when they don't perform well, or do you kind of leave it run all the time? And how do you let yourself do that all the time?
Well, I mean, the $1 million question is how do you know whether this is just a drawdown or whether the algo has stopped working, right? Which means the market condition has changed. And I think it's important to know in advance, and maybe I learned this the hard way. You need to have a backup stop in the sense that another way to say this, you need to have predetermined risk. So if I'm investing a certain amount of money, I'm going to say that my risk tolerance is going to be 40%, for example. When I lose 40%, I'm going to turn it off, and that's it. And then that has to be decided in advance because no matter how many years of backtesting you do, backtesting never ever gives you a complete picture, right? And so even though I've done backtesting for 10 years, 20 years, 35 years in all different kind of markets, the markets have changed significantly. You only have a limited amount of trades, right? And so this is just a statistics situation where you have no matter what, say for example, you have three dice and you keep throwing three dice in a row. You do it long enough, essentially you're gonna get a hand with all sixes. And there might be a case where you get three sixes four times in a row. If you do it long enough, you will run into that. And so it's the same thing with trading. The backtesting will give you some information, but it won't give you the whole picture. And so you need to have the picture can be better than you've known, or it can be worse than you've known. And so you don't know how long it's gonna take either way. And so you need to have preservation of capital essentially as the number one priority. So you need to make a decision in advance, decide what your maximum risk tolerance is, and if things go against you, you get unlucky things go against you, you have to take the losses and stop, because then you can live to fight another day, maybe. But if you lose all your money, you're out of the game. So yeah, I mean that's a very important question.
Is there a sweet spot when it comes to how many strategies you have in your portfolio? Is it like the more the better, or do you get to a point where all the strategies are kind of all correlated together, where there's no point to have more than like a certain number of strategies in a portfolio?
Yeah, that's an interesting question. I think I was actually thinking before this podcast of some things I wanted to talk about, and I mean one of the mistakes I made in the past is I tried to diversify, and in order to diversify, I used some strategies that a friend of mine had told me about, and I wasn't 100% familiar. It wasn't right into the my kind of stuff that I was doing, and I lost quite a bit of money on it. And so the lesson there is, yes, diversification is important, but I think I'd rather stick with less strategies that I'm familiar and comfortable with than try to put in more strategies that may be more risky or more stuff. It's always a balance. I mean that's one criticism people sometimes do of Warren Buffett, right? I mean, he's a value investor. That's all he does, and sometimes he has in the beginning at least he has his holdings concentrated in a few key stocks, but his defense was I'd rather have something in stuff I am comfortable with than go into stuff I'm not. So I think I stick by that philosophy too.
Have you ever thought about diversifying to other assets, other instruments, like let's say Forex, or let's say adding stocks to your ETF or something of the sort to diversify more?
Yeah, I think these ideas apply to anything you're trading. I've looked at Forex in the past. I mean, I think what Forex offers, I think that other stuff don't, is the huge leverage. I mean, it's the same, right? I mean, you can either choose a stock, say Tesla, that will move 20% in one day, and you trade a little bit amount of money and you get 20% return on a small amount of money. Or you can use the pound yen, where it will move by 0.5% a day, and then you have 50 times leverage. So the ideas are, I think, the same. I think some things that change are speculation. I think it might, from a trading perspective, I think one might be able to make money more in a speculative market than in a fundamental market. Although, if you're a fundamental trader, then of course you want to look at the fundamental market as opposed to a technical market.
Do you think if someone without a kind of coding background could go into trading algos and coding them properly, or would they need to at least have some background in terms of coding and in quantitative trading before going into coding their own algo?
I think today, like I said, I'm kind of a little bit of a odd man out because I didn't even use trading platforms. Like I used, like I said, Fortran, which is a language that nobody ever uses pretty much anymore, but it's very similar to Python. But I think there's quite a few sites out there that allow you to do backtesting without much coding, or they have simple coding stuff where you can write like an easy language or something like codes that you want to test. So I think anybody can do it now. It's very accessible. Plus, they offer you free data and cloud servers and everything. So,
But do you feel like you can code the same kind of strategies with that than what you trade, or could it be like really different what you can code with these?
oh yeah, you can. I mean, I think I did have some advantages in that I wasn't using a standard platform. I think I was kind of totally on my own, and so I didn't have any influences. Um, but it's very, like I said, it's very similar, and I think the ideas with trading, I'm not sure there's any secret or anything. I think it's more about finding the right market and finding a strategy. Like, I'm not sure. I mean, this is another thing I want to mention from my experience. I'm not sure whether the strategy is the key or the market is the key. Like, for example, I give you an example. When I was looking at starting out in futures, I was testing different markets, and one of the markets I tried was gold, the gold futures, and pretty much every strategy you throw at it, it's gonna work, right? It's just because it's the nature of the market. So it's not really. I mean, sure, one strategy would be have a higher risk reward ratio than other, but and it's the same thing with volatility or even the stock markets. I mean, stock market has an upward bias, right? So if you're trying to find a long strategy, I mean, that's very simple. It's probably gonna work. Even a moving average worked until probably 15 years ago when the market changed. So I think it's more probably to do with the market than with strategies per se.
What are some of the mistakes of quantitative trading in general? I know we covered a few of them, like curve fitting and stuff, but what are some of the mistakes people make when they go into quantitative trading and algo trading?
Well, I think curve fitting is one of them. Number two is thinking that your backtesting represents the whole situation, right? So you can never have that. So your past drawdowns are not going to be your future drawdowns. I mean, I've had strategies, I launched them and they did better than all my backtesting, and I had strategies that they did worse than all my backtesting. So, like again, same idea that backtesting is never a complete picture. And these are strategies which were tested for 10, 20 years, not just a couple of months. So, all kind of cycles and market conditions.
One of the things that I see a few people make a mistake with in terms of algo trading is that they think because they get a strategy coded that they will completely eliminate all emotions from their trading. They'll just be able to trade correctly from there, have the strategy run directly, and not have any like issues with their mindset or emotions or something in trading. And that's kind of a mistake because you always want to sometimes turn it off. You want to change it. You got to be disciplined and not like changing your algo all the time. You got to kind of stay and stick to it. And you got to, at the same time, like not turn it off all the time. So you're always going to have these emotions coming up.
Yeah, I agree. I mean, I guess I never had that issue because I was kind of driven by the algorithm. But yeah. I mean, clearly, if you can't be turning it on or off, either do it or not do it. So
Any advice you want to give people in terms of how to start into algo trading? Is there something they should do first? Should they code first? Should they practice coding? Should they study more the market? What should they focus on at the beginning to code their algos or become quantitative traders?
oh, I remember what I was gonna say. I guess the other thing I was gonna say, which is what I mentioned yesterday earlier, the other mistake I think people do is they think that indicators have some magic information into them, and there's no magic information in indicators. Which is what I said before. No, I think if people want to be a quantitative trader, I mean, they can start anyway they want. I mean, not everybody has the same path, so whatever gets you to your objectives, but clearly, you have an idea. You start by observing the charts and try and see what you can replicate and try and see if you can write down the rules, right? I mean, I talked to a little bit about quantitative trading and the approach to it in my book, but Yeah, those are the simple steps you follow. You do start with observation, and then you try and define it in terms of a set of rules, and then you code it up. And then once you code it up, you can run a back test and see if there's any merit to the ideas or not. I mean, one thing, I have a friend of mine, and he started in trading about a couple of years ago, and he was doing a master's degree. And he's also a fan of your show, by the way. And I mentioned one piece of advice I said to him is be careful, because it's very time consuming and it's not easy, and 99% of the ideas you try don't work out. So you have to be careful on what you want to spend your time on, and because it's a big time sucker, right? And so you have to think, do I want to spend my next 3 months coding this algorithm, or do I want to develop an app and sell, I don't know, t-shirts? Because there's different ways of, ultimately it's a business and you're in it to make money, right? Because coding is fun. And the other danger with it is it's endless. Ideas, you never run out of ideas. Just look at the chart, and endless, and parameters and this and this, and you can keep trying and trying and trying. And before you know it, a year has gone by or 2 years have gone by. And so you have to be very careful, because it can be, a bottomless pit of time. So I think that's kind of the main. If people take something from this podcast today, that's kind of what I'd like them to take. It's like, you have to really think about it. This is what you want to wear. I mean, it's fun. I mean, and there's the appeal that, I can find an easy way to make money and stuff. But it's can you, right? At what cost?
That's very good advice, very good information there. And also the fact that you need to draw a line into like how much time you're going to invest into one strategy, because you could put all your time into one idea that you think will work out, but doesn't work out in the end. And it's like the balance is like, where do you stop investing time and money into that idea and kind of switch to something else?
Because it's like, what if I do this? What if I change the exit? What if I do this? And before you know it, I mean, it's not easy. I don't think I can test anything in less than a week, probably now, to do a good job of testing something. And I mean, do I have a week to afford on that, or do I rather go on vacation for a week or watch TV for a week? Is the time better spent? So you have to be careful.
And with that being said, where can people find you or connect with you after the podcast? Where can they see your work and connect with you?
Yeah, I have my website is quantopolis.com. And I can send you some information, and they can free to email me or something, whether they want coaching or whether they want to talk or whatever. I'm happy to share my experience.
Awesome. We'll definitely put a link in the show notes of the podcast and in the YouTube description as well. So the links will be there for people to contact you and see your work there. You have a good information on your website as well. So I was just looking at it before. Your website is pretty good for that. So we'll leave that below for sure. I appreciate you, Michael, for your time and the advice you gave here. I think it was pretty awesome to hear your experience from algo and like the quantitative aspect of trading, which is I also like to learn a lot about. So that's awesome. And I hope we can catch up pretty soon and discuss more of that topic next time.